Thank you for tuning into the All Funds podcast. My name is Mike Schroeder. Today we are joined by Isabelle Tashima. Isabelle has a background in investment banking with Goldman Sachs. She did private equity with KKR, and now she's currently working growth equity at Volition Capital. So, Isabelle, thanks so much for joining us today.
Yeah, thanks for having me. Excited to be here.
Absolutely. Let's start off with talking about in terms of growth equity. So, maybe just start with what is growth equity for those that don't know, and, how is it different from venture capital or private equity? Because I'm sure that's a question you get a ton.
Yeah, it's a good question, and I think it's fundamental in terms of thinking about the type of partner that you bring on if you're a founder going out to fundraise. So if you think about early stage VC on one end of the spectrum, and then you have late stage PE on the other, growth equity kind of sits right in the middle. So VC typically backs companies that are mostly unproven. So their early revenue or pre-revenue tend to have a higher failure rate, but the winners can end up returning the entire fund. So the bet is more on potential, and the risk reward profile tends to be higher. PE is on the opposite end. You're typically buying mature cash flowing businesses. Often you're using debt. And that value creation playbook is more operational. You're typically cutting costs, optimizing margins. Maybe you're doing some M&A, and they typically are control deals in more mature businesses. So that risk reward profile is lower. Growth equity, as I mentioned, sits kind of right in the middle. So we're writing meaningful checks into companies that have already proven something. So they have a product that works, or in market, they have customers that love it. But they're usually raising capital to scale what's already working. So you're not really underwriting an idea. You're underwriting whether that idea can actually scale. So we usually come in when companies have about 5 million of revenue on the low end, and we'll come in with a check anywhere in the $20 to $70 million range. And usually we're minority partners.
So we just talked about just like what is growth equity. So, okay, so you guys are kind of in the middle. These are businesses that are growing. These are businesses that are obviously past seed stage. They have $5 million of revenue. What are these companies typically like companies that are looking to scale, pour a little like gasoline on the fire, or why do they typically want capital from you guys?
Yeah, that's right. It's usually to accelerate something that's already working versus companies that are looking to take on capital to fix something that's not. So oftentimes it's use cases of capital can be growing the sales team. It can be executing on the product roadmap. It can be international expansion. But usually we want to feel like there is a repeatable motion from a go-to-market perspective, and customers like the product, and it's a scalable motion that if we put capital in, we kind of know what's going to happen on the other side.
Mm-hmm. Let's get into the type of companies that you guys like to invest in. So you guys, it looks like you cover a ton of different, sectors. Maybe walk us through kind of some of these different, types of opportunities that you guys are looking for, and maybe even how you guys find them.
Definitely. So we are generalist technology investors. We'll invest across the landscape of enterprise software, tech-enabled services, higher volume transactional businesses, and a bit of consumer as well. So it's both B2B and B2C technology companies. We are sector agnostic. What we look for is on the fundamental side. So usually the companies that we're investing in have done a lot with a little. Oftentimes we are the first institutional capital into the business. Maybe they've raised a little bit of early capital from angels or a small amount of seed capital, but usually it is very capital efficient businesses. And then from there, we tend to be a little bit more contrarian in nature. And so what I mean by that doesn't mean we're trying to just go against the grain for the sake of being contrarian. It means that we tend to spend more time looking maybe where others aren't spending as much time looking, rather than following the hype cycles of the broader market. So specifically more in categories that often get dismissed by maybe it's surface level noise rather than actual fundamentals. So at the core, we're looking to invest in companies across industries that are solving real problems with strong fundamentals, customers that like the product, and are very capital efficient in nature. But that sometimes can mean that when a specific sector falls out of fashion, so to say, whether there's like a stigma on the surface from an earlier like failed cycle, or an industry looks kind of like boring or low tech from the outside, we'll spend time there looking for opportunities, because that often means that there's mispricing happening in the market and there are very good businesses that still exist there. So we'll look across the spectrum from an industry perspective, but the core in terms of what we're looking for from a business fundamentals perspective is consistent across sectors.
Is there any specific verticals or shifts that you think are currently like flying under the radar?
It's a good question. I think everybody right now is spending time looking at AI, of course. That is the current kind of cycle that we are in. And we are thinking about AI. We have to be thinking about AI. All of our portfolio companies are thinking about AI, and it's sort of table stakes at this point. I'd say where we're not spending time right now is participating in the like 100 million plus pre-revenue AI rounds, mostly occurring on the West Coast. That's just fundamentally not our model. So we are we're looking for businesses that are built on like real revenue, real customers. And I think the multiples in that part of the market are very disconnected from anything that you can underwrite with like real discipline. And so I think there is a whole section of the market for companies that are more AI enabled in nature, that are using AI to completely augment the business from a margin perspective, from a product perspective, that might be flying a little bit more under the radar because they're not participating in the, very high flying AI rounds of the Silicon Valley. And so we're spending time with those types of businesses, ones that have moats around distribution, around data, around brand, around community. We're spending time looking at more verticalized AI plays where the team has some sort of domain expertise, or again, a data advantage. And we're also spending time looking at more services-oriented businesses that can use AI to, again, completely augment the margin profile of the business. And what was once a low margin, like services business, can be a very tech-enabled, high margin, very scalable business. And I think that's happening in the background in very like boring industries that people may not be looking at.
I mean, first thing that comes to my mind is like HVAC. Like, is it like these type of companies that are kind of using some AI features to, whether it's maybe customer service, finding clients, advertising, that are using AI?
Yeah. It's businesses that are operating in large markets that are historically pretty kind of low tech or boring, that are quietly adopting AI in the background. And you're seeing it play out in the structural margin profile of these businesses. And they're able to move faster, innovate faster, serve more customers, and do it all with smaller teams. So it is happening quietly in the background. And so we're looking for some of those opportunities that are maybe flying a bit under the radar because they're not fully like AI native on the product side.
That makes sense. With how tell us about your investment process. So you guys, you find a company you like. How do you go about, making sure that this is the right opportunity for you?
We spend a lot of time during diligence getting to know the management team. It is a longer term partnership for us. So we're usually partnered up with companies for anywhere between 5 and 10 years. And so making sure there's alignment with the team is very important to us. So we typically start there, and then we look for, is there 5x plus potential with this company? And so oftentimes where the business that we invest in looks very different from the business that we exit 5 to 10 years later, and that's by design. So we want to partner with founders that have aspirations to become category defining, and that often involves an evolution of the product and of the broader strategy. And that's part of our underwriting as well. And so we'll spend time understanding that vision and that roadmap. And then, of course, we're looking at evidence of, is there a repeatable motion here? Is there a scalable motion? Is there pattern recognition? And so we'll look at all of the common KPIs, like understanding what growth, retention, profitability, where customers are being acquired, sales efficiency, all those good metrics we'll spend time understanding as well. But typically the entire process for us is about 2 months, and that's from initial meeting to closing. So we try to keep it pretty efficient. Oftentimes, the companies that we partner with, this is their first time really raising capital, and so we try to, keep it very efficient for them to go back to running the business.
Yeah. And it sounds like you guys are pretty like hands-on too with a lot of these companies that you're working with. Yeah.
I would say it's more of a pull versus a push model for us. So we are typically minority partners. We don't usually take majority positions, which means that we're not trying to operate the business from a day-to-day perspective. We want to support the management team to the extent that they want to leverage any of the resources we can provide. So we've built out an operations team internally that can help our companies with anything from talent, recruiting, marketing, finance. We have a strategic advisory board. And then we also try to facilitate collaboration across our portfolio companies as well through like in-person summits. We have an online portal. We have Slack channels. And so it's very much more of a pull versus push model in that we don't push any of these resources on our companies. We want to partner with founders because we believe in their ability to execute and we believe in their vision. We're just there to support to the extent that we can be helpful. So I would say we are involved in that we treat every portfolio company like they are our only portfolio company. And so we build a very concentrated portfolio by design so that we can be active partners. But we are not trying to operate the business on a day-to-day.
Yeah. I like that. The pull versus push. You have the resource that they want them. If they don't,
right,
no worries. On that note, how many companies do you guys like typically try to, I assume you have like the fund model, where you have, a fund 1, fund 2, fund 3. How many companies you guys looking to put in, into a portfolio?
The current fund, Fund 5, is $675 million, and we will likely make 15 to 20 investments out of this fund. And so that means we are building a concentrated portfolio of a small number of companies that we really believe in, and we see that upside in, and we also believe in the one next downside as well. So these are real businesses with real customers. And so that's kind of how we think about our underwriting and how we think about our portfolio construction.
Yeah. Capital efficiency is coming up a couple times. In terms of capital efficiency, what does it mean to you?
Usually these are companies and founders that have done a lot with a little. And so capital efficiency to us doesn't mean never invest in growth and never raise capital and never spend anything. That's definitely not our goal. Obviously, we want our companies to grow. And if that's the right path and they need to invest in growth, they should be doing that. But it's more around, hey, do we have the signals and are we tracking the right metrics to understand what's going to happen when we invest in growth? And so it's more around being aligned on, hey, we're not going to go out and raise hundreds of millions of capital just to burn through it all, because we don't want the founders themselves to also risk their entire company doing that, which oftentimes these founders have most of their net worth tied up in their equity. So we want to allow them to achieve their dreams, grow the company, have a great exit without risking it at the same time. And so we believe that involves being capital efficient, understanding what's going to happen when you put $1 somewhere. Usually they're pretty scrappy teams. And so that doesn't mean that every company is profitable when we invest. Some are. Most, I would say, are not. But it's understanding how do we get there, and what are the use of proceeds going to be, and do we know what's going to happen when we put capital towards something? So I think what's happening right now in the market is you're seeing these companies that are able to be much more capital efficient with smaller teams, spend less, iterate faster, and it's kind of opening up the universe of companies that can be capital efficient because AI is enabling them to automate a lot of work that they historically used to have to spend on.
Yeah.
So that's an exciting trend happening from a sourcing perspective for us, is just companies that are able to grow faster while being more capital efficient.
Yeah. Has this trend changed over time? Because it seems like, we all look at, back in like 2010 where, capital was kind of free. It seemed like private equity was, subsidizing our Ubers and whatnot. How has that trend changed over the years? It seems like today more companies are a little bit more capital efficient than they used to be.
Yeah, I think the market goes through different cycles where capital is easier and harder to get. I think you're seeing on one end this bifurcation of like companies raising tons of capital right now. They're likely burning tons of capital at high valuations. And then you're seeing this other side of the market of companies that are realizing they don't actually need to go out to raise a seed. They don't need to go out to raise an A because they're able to do more with less, with smaller teams, with product that they can build faster and cheaper. And so I think there is like a true bifurcation of what's going on right now. And that has varied over time, but I think you're going to continue to see that evolve. And I believe over time it will start to converge because I think the valuations and what's happening on the side of the market that's raising tons of capital at high valuations, at high multiples, that will eventually come down to meet. And I think the companies that are able to do more with less and raise less and are also growing over time, I think those will start to converge. But you're definitely seeing sort of a bifurcation in the market right now.
Yeah. These are questions that I like to ask a lot. Tell us about like maybe one of your biggest wins, and then eventually we'll talk about one of your biggest losers.
I would say one of our biggest wins that kind of ties into our contrarian thesis was our bet on Chewy, the large pet e-com retailer.
Of course.
At the time, it was a very boring low-tech category. There had been some prior failures in the space, and I think people,
who could forget?
Pets.com. Yep, and I think the broader sentiment was like, as an investor, oh, we're just going to stay away from this category. And there were many other investors that had passed on the business for very valid reasons at the time. It was, for all the ones that we mentioned, plus it was a very low gross margin business as well. But I think we saw it as an opportunity for a company to come in that was very focused on the customer experience, very close to the customer itself. And these were highly emotional customers. Like, people care a lot about their pets, and they were able to leverage that emotion to foster loyalty through being very close to the customer. And that was their true competitive advantage. And so we saw that manifesting in very stable cohorts. Like, people would sign up for auto ship and they would stay on it. Mm-hmm. And when somebody would cancel their subscription, it was oftentimes because a pet had passed away. And so the company would send them like portraits of their pet in the mail. They would send them flowers. And it was those little things that was able to keep customers coming back. So even if their pet passed away, they would come back for their next dog. And it fostered a very strong community, very strong customer loyalty that showed itself in the metrics. And the business ended up being a very large, successful investment for us. But that was all starting from an investment that at the time wasn't a super obvious investment in a obvious category that people loved at the time. And so I think that again speaks to our approach around looking where others might not look because there is mispricing that might occur for various reasons.
Yeah, great example. Any losses, any bad companies that you guys maybe invested in that, and I'm sure there's some good lessons you take away as it happens.
Yeah, I think every fund has lessons that they learn over time through different investments. And I think one of the interesting parts about investing in different types of companies across different sectors is that you learn from many different examples, many different business models, many different industries, and some of it can be macro related, some of it is inherent to the business model. And so I think through some of our direct-to-consumer investments, especially ones that have inventory or product components, we've learned that forecasting consumer demand can be very tricky. It's very sensitive to market dynamics, through what's in favor, trends can shift rapidly, and forecasting inventory can be difficult because of that. And so that's a dynamic that I think we've learned over time, seeing our companies go through different cycles, especially COVID, which was an interesting cycle. And we had companies that were doing awesome because of some of those trends. And then it definitely created some noise with forecasting inventory and understanding what demand's going to look like. And it can be very hard to predict. And so I think that's a broader lesson that we've learned through some of our consumer investments that we have seen play out. But I'd say because we are longer term partners, like these are 5 to 10 year partnerships, there's a lot that you learn over time. And I don't think that the path is ever linear for any of these companies. It's very rare that it's just straight and up and to the right.
For sure.
So it's natural that there will be bumps along the way, and the line often looks more up and down than it does straight and to the right. And so I think there's learnings from all of our investments, even our best ones haven't been up and to the right. So I think that is one of the benefits of being a longer term partner, is just getting more data points, being there along the way. We want to be there for not just the good times, but also the bad times. So definitely a lot of learnings.
For sure. What's a signal you see in early companies that, you think could make it a market leader even before the numbers will fully prove it?
It's a good question. I think one of the most important patterns we see in some of our best companies is an obsession with the customer experience, specifically, I think, for D2C companies. So founders and management teams that are extremely close to the customer, and they build the product with the customer in mind. And I think that remains consistent for companies that are pre-revenue, that are 10 million of revenue, that are 100 million plus of revenue, is those teams have stayed very close to the customer over time. And you can see it play out in their retention figures, in their NPS, in their reviews, and in the community that they're able to build because of that. And it often manifests in organic acquisition, in strong social presences, in community. And it often creates like a natural flywheel for these companies. So I think it starts with finding a founder that's like truly obsessed with the customer experience.
Yeah, the founders for sure. And you touched on social media a little bit. When it comes to the social media, modern distribution, obviously a lot of that, comes through social media. How do you think about founders, building audiences today and, being more of a moat than just, kind of a marketing presence?
I think it's becoming more and more important because brand and community and distribution is a very important moat in today's world and will continue to be, I believe, moving forward. And so I think you've seen this shift over the last few years from companies leveraging traditional paid channels that were becoming harder to scale over time and more expensive to scale, to flipping toward leveraging social, toward leveraging organic referral, toward using influencers, affiliates. And so now today there's more options from a channel perspective to put ad dollars. And I think some of our best companies have actually gone the route of not using traditional paid channels, which maybe is a little counterintuitive for direct-to-consumer businesses. But I think if you're able to turn your customer into effectively like your marketer, and whether it's leveraging social channels or creating a referral program that naturally loops itself, like you're able to scale your acquisition motion in a much more capital efficient way than just pouring money on paid channels and seeing your CAC go up over time. So I almost think today, if you're selling direct to consumer and you're not leveraging social channels and not building community, like you're behind. And that will start to manifest in your KPIs over time. But some of the best companies are using it in a way that's able to continue to build community, continue to build brand, and over time, it's almost an upfront investment where over time you're going to see that start to build a feedback loop.
You guys are looking for 5 to 10x over 5 to 10 years. I guess talk about the companies that make that happen.
It's kind of like the ultimate question, because if we knew the exact formula, it'd be much easier to find investments. But I would say like there are common threads across some of our best performing companies. At the end of the day, I think it starts with management. Like you can have a great product, but if you don't have a great team and you don't have distribution, nobody will be able to buy the product. So we ultimately are looking for founders that we believe have some sort of like special sauce almost. And it can come through the form of like domain expertise. It can come through the form of like being fully customer obsessed. It can come through founders that are more visionaries. It looks different across different companies, so it's almost hard to describe in a sort of template format. But
So founders is a big aspect of it, though. It sounds like.
yes, founders are definitely key to the underwriting. And then beyond that, it's like aspirations for greatness. So there are a lot of businesses that can be great businesses, have great metrics, but they're more of like almost lifestyle businesses. It's a great business for the founder to own, to run. Maybe they're dividending themselves every year, and it can be a great business, but if the founder and the management team doesn't have aspirations to build this to like be fully category defining, then we don't believe it's going to fit the 5X for us. So it's kind of about understanding where the business is today. Yes, it's working. Yes, it has customers, but it's going to look different in 5 years. And what does that look like? And how does that overlay with how the broader market is going to look in 5 years? And so it's kind of this intersection of founder, product, and market that we try to layer in. And the way that we prioritize those factors looks different for every investment. But at the highest level, like those are some of the things that we're thinking about. And I think our best companies have a combination of all three. It's market tailwinds where the company is moving where the market's moving. It's a best-in-class product that's built for the customer, and then it's a founding team that has like very big aspirations for success and is set on building this to be a very big business.
I do want to spend a little bit more time on AI as well. I know you touched on, some of these different ways that these companies are using AI. How's your team using AI?
We are definitely using it internally. We are, I think, similar to a lot of companies out there, trying to optimize our back end to automate workflows that historically had been very manual. So for us, that looks like finding companies that could be good fits for us used to be pretty manual. And we were out there, looking across different platforms, reaching out manually. And still some of that happens today, but largely we're working on ways to automate those workflows to get us in front of the right companies that are going to be good fits for us and for the founders that we are looking to partner with. And so we're using it on a day-to-day basis. We're having fun. We're building agents. We're trying to share those learnings across the firm. We're taking advantage of an exciting time to innovate, and we're definitely trying to work internally to both automate, but also make sure that we're collaborating and sharing those learnings at the firm level. So it's rapidly changing how our day-to-day is looking, but at the end of the day, it is still a people business. And so we're still meeting with founders in person. Like that's very important to us. I think business will be done people to people, but it doesn't mean that you can't use AI to make you more productive.
Yeah, for sure. I mean, even obviously, like looking through the pitch decks, I'm sure a lot of that could be automated and make things quicker. Does it help with like finding companies? Could you guys kind of use it for like outreach and I don't know, things like that in terms of you want to make these investments, so you got to find those right companies.
Right.
Does it help in those aspects?
It does. I would say that email is largely getting commoditized, though. It's almost everywhere that people are using AI to write and send emails. And so founders, I found, are getting inundated with AI emails. And so for the very best companies, we're still getting on the plane and meeting them in person. And that's an important part of what we view to be like our differentiation and how we get deals done. But
Yeah.
we are using it to surface the companies that will be the best fits for our mandate and where we typically play. And so what maybe used to take us 30 minutes to go out there searching around, finding a company that could be interesting to us, like we're getting that feed automated to us, to then allow us to do our job and go out and meet entrepreneurs.
Yeah.
But it is, I would say, automating the very top of the funnel for us.
Yeah, that's interesting. Do you guys get a lot of like inbounds, or is it more like through the network that these opportunities arise?
We're mainly sourcing ourselves, so we've built a pretty proprietary like sourcing engine that we have a lot of our team using, to help us find, identify, and then reach out to these companies. But usually it starts with a cold outreach from us, and a lot of times the founders aren't even looking for capital. But I always tell founders, like, keep an open mind, because you never know when the right partner is going to come along. There's a lot of funds that just won't be a good fit for what you're building, but it can sometimes start with just a cold outreach.
Yeah, all it takes is a conversation. Um, in terms of founders, I did want to double click on that once more. What are some like red flags that you guys have found, like things that makes you don't want to invest in this company?
I think most of the time, common past reasons for us might include, like, we don't feel like they have yet a repeatable motion. So a lot of times we're looking for pattern recognition. We're looking for stability in where they're acquiring customers, what it costs to acquire a customer. Is it all coming from one channel that's more one-off in nature? Is a lot of the growth coming from one customer? And so a lot of the times we're looking at those KPIs, and if we don't feel like, hey, this is scalable, this is repeatable, we can put fuel on the fire here and know what happens, then maybe we need more time to watch it play out. And so that's a common reason that we may pass. Sometimes for companies that are forging their way toward developing a new market almost, or a new segment of the market, could be that we need to see that play out a little bit. And we are looking for product market fit. So again, if we overlay product and market, if we don't feel like the market's there, then we may pass. Mm-hmm. And then on the founder side, I think founders who don't necessarily want something beyond the capital maybe aren't the best fits for us. We want to be active partners. We take a board seat. We want to be helpful. But there are some founders that don't want to give up control, and they don't want somebody on the board, and that's totally fine. It's just not going to be the best fit for our model. And so oftentimes, perhaps those are the ones where we don't have alignment there, and it just won't be the best fits for us.
Makes sense. You guys have all the resources for them. What what's something that a founder should be asking before they take capital? From kind of the other side of the fence. What should they be thinking about before they go raise from Volition or somebody else?
I think they should be thinking about the things that we're thinking about. So, do we have a repeatable motion? Why are we even raising capital to begin with? Sometimes I see companies where we take a closer look at the company, and we actually don't think they need to raise capital. Like, they are capital efficient, they're self-sustaining. I think capital should be used to accelerate something that's already working, and if you don't raise, then you're leaving opportunity on the table. But if those things are not true, then maybe you don't need to go out and raise capital. So I think that's the very high level, like, number one question founders should be asking before they even spend time preparing all the materials to go out and raise. And then I think they should be thinking about, obviously, like, the investor that they choose to partner with, but again, going back to the very first thing we talked about, like, what is the risk reward profile and the risk return profile of the investor that is joining your cap table, because that can impact the timeline for the business, alignment on operational plan, alignment on growth, alignment on capital efficiency, and all that is influenced by how that investor underwrites the investment. And so the investor writing the check, or that's willing to give you the check, might not be the best one to join the cap table, and might not be the best investor for the company based on the founder's specific incentives or plan, or how they're thinking about their own company. And so I think those are all questions that founders should be asking investors, is understanding how they're underwriting, understanding what the day-to-day looks like, how involved they want to be, what resources they have, what their exit timeline is. All those questions they should be thinking about as well.
Mm-hmm. If we were to be having this conversation 5 years from now, what do you think will have changed most about growth stage investing and companies that attract capital?
It's an interesting question. I think so much is going to change. It's almost impossible for me to imagine like what the world looks like in 5 years, but I could see it being very small, sub 10 people teams that were founded 6 months ago versus 3 years ago.
Mm-hmm.
And I could see a lot more companies becoming very large without ever raising capital. And I think the industries that we're investing in today will look vastly different from the companies that emerge from them in 5 years. I don't know what they're exactly going to look like, but I know it's going to be different than what we're seeing today, just based on the pace of how quickly things are moving. So it's a hard question to answer, but short answer is I think it's going to look very different.
Yeah, I think AI will continue to I mean, to your point, a lot of these companies could be bigger. They more efficient, less people. AI's changing the world like crazy. So
Totally.
see where it all goes. Awesome. Well, Isabelle, this has been a lot of fun. I think this is a good spot to wrap up. Any final thoughts, and where can we send people to connect with you and learn more about Volition Capital?
Yeah, no, thanks so much for having me. This was great. People can go to volitioncapital.com, and it has all of our contact information. You can also find us on LinkedIn, but our company website's probably the best way to find us.
Awesome. Make sure to check out Volition Capital. Isabelle, thank you so much. Really appreciate you joining us.